Many people get into investing and learn many hard lessons along the way, often as the result of some bad choices. But with the right, sound, foundational knowledge, people can not only minimize their risk, but also maximize their gains. Having the right mindset initially will ultimately be a major benefit down the road. The Money GPS TRIFECTA method is a simple and yet underutilized strategy that everyone should know. You came here for the truth, so let me unveil that for you. Today we are going to talk about the Money GPS Trifecta investing methodology. Like I said, it's simple, it's easy, but not enough people are using it. So I'm going to go over the basic points, and I think that people should take this and build from it. Understand that this is just the basics, but I want to show you this, and I want to look a little deeper in future videos. The summary here is that you need to hit at least 3 angles for diversification and maximum potential. When you have these 3 or more angles on a particular subject, you are going to have much more control, you're going to have much more diversity, and of course, less risk. When you only have one point of failure at some point, that will ultimately be realized, and that is never a good thing. All of the examples and specifics we will discuss are simply there to illustrate a point and are not meant to be advice in any way. I'm going to show you stocks. I'm going to show you different companies. I'm going to give you some real world examples that are literally just that. They're examples. I'm not telling you to do these things. I'm only trying to explain the methodology. So I just wanted to make that clear up front. First, we need to understand the psychology. The psychology behind the strategy must first be established. Before you ever go a step in, you have to understand the mentality behind it. That's why when people are copying what Warren Buffett is doing, or what any of their favorite YouTubers are doing, or somebody that they found online, or this guy or that guy, it is not sufficient because we don't know the mentality. If we read an article, you might get little tidbits here and there, or you know of a particular quote that's been constantly spread out there, and you think that that's part of the entire strategy. It's not the way it is. We have to have the entire psychology behind these aspects in order to be and to know that this is sound investing. Why do you believe that this is a valuable investment? You must ask yourself that question, and you must be certain about it. Well, I think the price is going to go up. That isn't in itself a reason why you should be doing so when we look at the psychology. Part of the value and the reason that you want to purchase it is because it will have more value in the future. Obviously, that's why you're getting into this. But we need to look at the deeper levels behind that. Let's talk about trends. Establish what you believe the trend will be. So you've got to know that. You have to say not just the price will go higher, but what is it here that's happening? You have to understand it on a deeper level. And here's the example I use, and something that we've talked about quite a bit recently. Commodities super cycle has begun, or at least that's what some are saying. So prices of food will go higher. That's the example I'm using. How can I capitalize on this trend? Some would simply buy commodities. If you think it's going to go higher, you buy commodities, right? Well, that's the traditional way that somebody would invest. But with the Money GPS Trifecta method, you can capitalize from multiple angles, reducing potential fault and increasing gains. I hope I'm making myself clear here. I'm going to show you the examples right now, but I just want to highlight specifically. You look at that simple fact. You look at that simple fact of prices going higher, so you simply buy it. But what if you can get it from different angles? Wouldn't that be fantastic? Wouldn't that be a way to actually benefit from all these different ways? Wouldn't that be something that you'd be interested in? Let's look. In that example of commodities, you have this. You can buy commodities futures and an ETF that surrounds it. Absolutely. That's one way. That's more of a direct way. Then you look at potash fertilizer. They're going to need that, of course, if they're planting these different agricultural commodities. Then you can look at other types of commodities as well. But for the agriculture, this is something that will be in high demand. And then there's also the companies specifically. Just an example, John Deere. Like I said, I'm not specifically showing you this and telling you that that's what you should buy, because you got to know about that company, John Deere, to understand if they are necessarily a good investment, considering many other factors. Maybe they won't be good because of a certain thing that's popping up right now. Okay. So that's the point. You're hitting this directly in a sense because you're getting those futures or the ETF that maybe buys the futures, or there are other ways to do that. And then you get another aspect from that, potash fertilizer, knowing that they need to utilize this in order to have those agricultural commodities, actually be profitable and so on as a business. And then the companies that are able to benefit from that. So you can see that you've got this different layered aspect to the investing strategy. Like I said, I'm sure there are others doing this out there. But to me, when we outline it like this and we can simply take it how I see it, it starts to make a lot of sense for somebody, especially those who are new to the game and don't have the depth of knowledge. This helps them break it down. Then we have tech stocks. So you can look at the particular tech company names directly. For example, a blue chip, you've got Apple as being one particular one that many are interested in. So that's just something that people would do. They think Apple's a great company. Apple sells a lot of phones and computers and iPads. So I'm going to buy Apple. But you go another level deeper. Semiconductor companies might also be something because those phones, those computers, those iPads have all these different chips in them. And so what kind of companies produce those chips? And Apple happens to be one company that's making a lot of their own chips. But in this case here, I'm simply making a point. And then we go to the next level, and that's the raw materials. Does it need copper? Does it need silver? Does it need gold? What else does it need that's inside of these devices that you would be interested in that are produced by Apple? Okay, or any of these other companies. So that's 3 separate levels, taking tech to a whole nother level. And then we have silver as well. It could be gold. And essentially, you've got people out there that will buy silver bullion, the exact same coin every single time, and that's it. They have the same denomination. They have the exact same thing. Silver eagle, silver eagle, silver eagle. But there could be diversification within that as well. You can get all different types of coins. You can get different denominations, all kinds, right? But let's take it a step further. You can get junk, or what they call it junk, but some also refer to it as common coins. And that's something special because it takes it down a notch, smaller denominations, and you're getting this in all kinds of, you can get a bag of this stuff. It has a face value. It's a commodity. There's so many different aspects to it. And then you have the silver miners. So you have these different companies that may or may not benefit from the price of silver itself. There are, of course, other companies that are mining other goods, and they can pull up silver from the ground. So it's not necessarily mining for silver, but oftentimes they're mining for other metals and they pull up silver. What kind of companies are doing that and have success, consistent success on that? And real estate, cash flow producing properties is of course the top there. You buy a property, multifamily property. It's got 50 units in it. Each of those hopefully has a renter paying you every month. It's producing cash flow, and you are able to profit from it. Then you have cash flow producing land. Let's say the example here of agriculture. And I was on Clubhouse just recently with my subscribers. Approximately every day we do this, and I had one individual talk about how he has agricultural land that produces cotton, that produces other commodities that he is making now passive income every single month. So that's something that you're taking. You could have a building on that land and there's a renter inside there giving somebody a place to live. They pay you month to month. Or you can have food that people need to live growing on that property, producing income. It can be farm, people do cattle and all these different things that produce income. That's one aspect to real estate, that's for sure. You can look at another angle, storage lockers. People today, they are moving into places and have tons of stuff. They need it either temporarily, or sometimes people throw their stuff in the locker and never touch it. Storage lockers are very interesting, okay? I talked about that in my second book. Companies that benefit, such as construction or raw materials. So within real estate, there's that other level to it, because it's not necessarily just buying a piece of real estate, buying a storage locker, what have you. There are also companies out there who, as the construction is moving, that's going to benefit them. You've got the raw materials, the producers of the copper and the lumber and so on. So these are all different aspects to real estate that we should be focusing on, not simply just what people think. Real estate, buy a house, maybe flip it, sell it. Maybe you're going to have a cash flow property on it. There's so many other things that you can do under that umbrella of real estate. And to finish this off, I want to talk about something that I think is absolutely integral, and that is your exit plan. An exit plan must be determined before the purchase is made. When you buy that stock, when you buy that house, whatever it is, you have to already know what you're going to do on the way out. So I ask a series of questions here. There's 100 more that you should be asking yourself. And whatever that is, I would actually write it in your notes, either on a paper or write it on your phone, do it somewhere. But write these things down and actually see what you as a person are thinking before you pull the trigger. What has to happen for you to sell this? Will you sell all at once, or will you sell in parts? Think about that. What exactly are you doing at this point in time holding on? Is it the right time to sell? What do you think? A lot of people don't think of the sell part. They only think of the buy. And then what do? Then they buy more, and then they buy more, and then they buy more. But is there any moment in time where you think you'll sell? Is there a certain number? Is that what you're going for? Well, you have to address that before the purchase. What if something were to happen outside of your estimation? So if you thought this was going to go up every single month on average over the next 12 months, but it's gone down 20%, it's gone down 30%. Okay. Suddenly there's a major change. How will that affect your exit plan? Okay. Think about that. If it's a stock, what price will you sell at? Real estate. What happens if it's vacant for X number of months? Then you must figure out what you plan on doing with the proceeds. That's important as well. What are you going to do? You're going to have it sit in cash or immediately convert it into another asset. So maybe you say, I'm going to buy this stock. When it goes up to this price here, I'm going to sell it and then I'm going to keep it in cash. Or I'm going to sell it and I'm going to put it into real estate. You got to know that. And you have to determine that beforehand. All right. Any of these can have if statements attached to them, but that should be established before you purchase. So nothing is ever going to go according to plan. We know that already. But you can say, if this goes up to a certain point, I'm going to sell, I'm going to buy real estate. If real estate is not a good buy at that time, I'm going to buy whatever it is, cryptocurrency, or I'm going to leave it in cash for a short period of time and then buy gold and silver. Whatever that is, you have to understand that you should write these things down. If not on paper, do it on your notes app, make it known, have that established. And of course, it's something that you can always change. But the point here is that you know what you can and cannot do instead of panicking at the last minute. The most important rule of investing is always not losing money. Not losing money, because you don't make money over a period of 3 months, 6 months, or 2 years. You make money over decades and decades and decades. You have entire fortunes that get wiped out overnight. Billions of dollars get wiped out overnight because people didn't do the right planning in advance. Maybe they took too much risk. And unfortunately, for some, they'll learn the hard way. So that's really it for today. This is the Money GPS TRIFECTA investing methodology. I hope you appreciated this. Thank you very much.